All right. Oh, wrong button. Testing 1, 2, 3. See if anybody can hear me. That's step number 1. Once we establish an audio connection, we move on to the visuals. And after that, the fun begins. I'm eating nuts. Supposed to be healthy. Nuts and sunflower seeds. I don't know if these are cranberries or what the hell they are. We'll see. Is everybody having snacks? I'm having a snack. Didn't have time for lunch. So I keep all these mixed nuts by my desk now to see if that's healthier. No response from anybody. The idea is you type in the question box and say, hello, I can hear you, or something to that effect. Yep, microphone seems to be working. I don't care because these nuts are really good. So Brendan just goes right into a conversation. How is the hurricane? Clay has it correct. He's saying, I hear you. Brendan says, how is the hurricane? It missed me. Feel like Bugs Bunny. Missed me. So we don't even have rain right now, and it's all gone. I'm in Delray Beach, just above Fort Lauderdale, in the grand scheme of things, anyway. And we got lucky. We got very lucky. There was winds. They said there were tornadoes. My mother said there was a tornado right outside her house, but I doubt it. Anyway, and over here, we didn't see much of anything. It was we had a nice rainstorm that lasted basically all day yesterday, and now it's gone. And so we're lucky. It's just basically you're on one side of the, you get hit or you don't get hit. We got on the other side. In fact, the hurricane hit where I left last time. I drove to Naples in the last hurricane because the hurricane, you can see it on the map. And I mean, I don't know why more people, I mean, I guess not everybody can afford it, but it's, oh, you can't see this yet. I didn't even do the thing. Hang on. I put the video on so you can see it. Then it'll make sense if I show you a hurricane map. Hurricane map live. It doesn't look like hurricane map. Let's see. La-da-da. Let me know when you can see my screen. These are terrible maps. Must be like AccuWeather. AccuWeather. They're usually good at this stuff. All right, great. So apparently people can see and we're all in good shape. All right, so good. There's that. Hurricane. All right, so what's this telling us? Can I blow this up? No. Oh, yeah. There we go. Okay, so I'm here basically. That's me. And when the hurricane's coming to my side, which hasn't happened in a few years, but the last time a hurricane came here, you can see which side it's going to be. Is it going to be on this side of the state or that side of the state? So as soon as I see it's heading on this side, I'm not going to wait because you can lose power for like 2 or 3 days here. So I just get in the car, drive here. This is only it's not even a 2 hour drive. And I'm over here at Naples. And Naples is a lovely place. I just check in a hotel on the other beach. And then it's like this. And then being there is like being here, where it's like, okay, so there's a storm on the other side of Florida. Who cares? It's not far. It's only like 90 minutes across. But the storms go either that way or this way. They don't generally go from one. They don't generally go up. If a storm going this way, it's going to go up the coast. If a storm goes this way, it's going to trap into the Gulf of Mexico here. Now, of course, it can sometimes. They say this one's going to cross over towards Orlando and do God knows what after that. Orlando's up around here, I guess. And it's going to smack into Disney, but all these guys are in big trouble. Tampa's in big trouble, so on and so forth. It became a big storm. It became a very strong storm very quickly, actually. It's because the water's so warm. When the water's this warm, it feeds the hurricane. Oh, there you go. That's the kind of thing we like to see. Widespread impact. Who's that not good for? The insurance industry. They hate this. All right. Oh, man, really? That's like as big as it gets? Why is that? Open image in a new tab. Nope, didn't help. Anyway, so yeah, it's going to come in here and curve into Orlando, which is kind of a rare hurricane going across the state like that. So it's going to come in here, curving towards Orlando, and then they don't really know what's going to happen up here. See how wide this band gets? That's their band of certainty. But you know what we're certain of? It ain't coming back here. So that's that. Anyway, it's only a category 1 by the time it gets here, so no biggie. The state, that's what happens. They draw their power from the ocean, and then once they go over land, because what a hurricane does, it swirls and sucks up water, and as it sucks up water, there's a whole effect that makes it stronger and stronger. And that's why they dump so much water where they go, because they're bringing the ocean with them, basically. They're making a funnel that pulls all the ocean water up into the air, and not rain. This isn't like a little puffy cloud. This is the ocean water is being thrown 1,000 feet into the air, and it comes back down when they hit land. So it's a nasty thing. But then it loses energy because it can't suck up any more. It can't suck up any more water, so they tend to lose their energy when they get over land. But look at but it's going to bring rain all the way up here, and all these places are going to get a lot of like flooding and so on and so forth. It's too bad it's not going to the West Coast, because they would love it. They need the water. But anyway, so there's a few $1 billion worth of damage that's going to be done in the next few days, out of the pockets of insurance companies. I mean, obviously it happens every year, so it's going to happen. Hurricane warning is affecting 15 million people. Tropical storm warning 24 million people. That's a lot of people. Oh, here's rainfall. Look at this shit. 18 to 24 inches in basically up around Orlando in Disney area. Because that's right where it hits. It's got as much water as it can carry over here. It's dropping it here as it moves into the state. And then it's going to keep dragging water all the way, but 12 to 18, 8 to 12, blah, blah, blah. By the time it gets up here, it's only, a few inches of rain. It's not terrible. But down here, oh my God, that's going to be a lot of water in the middle of Florida. It's already a swamp. So good luck to all those guys, right? Crazy. I don't know what that's telling you. Oh, wind speeds. Yeah, look at that, 140, 160. That is going to be a very bad time for these people over here. And that's why I leave. I book, I call, I book a hotel. In fact, they even have policies where the hotels you can't cancel when there's a hurricane. They move their cancellation buffer up, and you can't cancel within like 3 days because otherwise everybody just books a hotel and then doesn't show up. But I basically just ride. I do this. I guess if it's coming here, I go there. If it's here, I go there because this is crazy. Why would you sit through this? If you don't have to. So it all sounds great, but then one day I might get caught in a storm. But in fact, the computer I give this webinar on is an all-in-one. What is this called? It's a Hewlett Packard Envy. Yeah. Well, all-in-one. Yeah, that's right. Okay, so I'll show you. So this guy, this is not my main computer. This is my webinar computer, but also what it is it's a computer. I can pick this thing up as is. It's got a nice wide screen, like 40 inches wide. So I have you know how artists have like a big giant thing they carry pictures with, right? Like a side holster that's very large that covers up their pictures, but I mean large pictures. So I have one of those it's not made for the laptop, but it works because this guy's flat. So I basically wrap it around, the edges stick out, and I take that. So when I go on a boat trip, or if I take a car trip or a boat trip, that's why when I go on vacation, I usually stay in Florida because I can take this thing I can take it in my car. I can't take it on a plane. It doesn't fit. But it's if I have this thing, I really don't need I'm good. I can see 3 different pages at the same time on the web. And it's a nice little thing. And mine's a little more compact than this guy's. This guy's got a tall back. But the whole computer is this and the keyboard and the mouse. And it's a portable office. I plunk that down and I'm good to go anywhere. So I really like this thing. It's gotten a lot of mileage out of it. I've had it for years. It is not that durable, though. It's not really meant to be carried around the way I do. So you got to be a little careful about that. But on the whole, though, it's fantastic, especially if I go on. So that's why I like to go on boat trips. If I go on a boat trip, I drive to Fort Lauderdale. I get on a boat. I carry this thing on. Boom, I sit down. Same as being at home. Same as my home office, practically. I've also got my iPad and I got my laptop. So I've got more screens. But that is a good way. So when there's a hurricane, I just take this and I leave everything else and I just go boom, and I get the hell out of Dodge before the power comes off and before everybody starts booking them. Anyway, so that's my story. Oh, I have one of these too. Oh, I don't know what that is. No, I don't have that. I mean, I have a portable LCD also that I hook up to it, so I have another screen on top of everything else. I love screens. It's good. I mean, you got to have screens, right? You guys must have multiple screens. Let's see. Okay, meanwhile, and the resolution, of course, for the webinar, I keep this is only showing one screen for the webinar because the fonts are huge and everything's huge. And I think you guys can see it better. If I'm regularly working, the resolution is way smaller than what it's showing on the screen now. I can fit a lot more on it. Also, it goes where you can't see. There's black, like a huge amount of black space on this side and a huge amount of black space on this side, and that's filled up when I use it in the regular mode. So for the webinar purposes, I try to keep everything on this one panel. And I think I do a damn good job of it. All right, so what did I want to do today? My agenda for today was to look at, what was I looking at? Okay, so that's last week. I can't believe September's like over. Crazy. So that's it. This is the end of the third quarter. The third quarter is done. And by the way, the world did not collapse and businesses aren't going bust. And, we haven't had a dire amount of warnings of profits and stuff. We have had some profit warnings like FedEx, which started the tanking of the market last week. But what we haven't had is a large number of people saying, oh yeah, we're going to have a shitty quarter. That hasn't happened yet. And now they're going to start reporting. And I don't think that the quarter is going to come off as badly as people think. As people think, as the analysts have been saying, that this is some kind of disastrous recession we're in. You can't be in a recession if companies are making money. You can't be in a recession if they're hiring. You can't be in a recession if their biggest problem is finding employees to meet the growing demand. It doesn't make any sense. Okay, so we got that. That's now the same as this. And what I wanted to do was leave this one on the current page and then go here and go to Tuesday. I like this now. I do like this thing on our new site. So, these are my most recent articles. I like my most recent articles. But yeah, I mean, people come here to read my stuff. So here's my most recent articles up here. And then everything else is down below it. But it's good for me because I get to check and say, what did I say yesterday? So what I said yesterday and where we left off, this is what I want to do today. If you have your own agenda, ask some questions. But let's talk about what makes a good and bad stock in a given situation. So GNRC. There. Okay. So what did we get up to? We got up to, we did Halliburton. We didn't do Schlumberger. Okay, that's where we left off. So we left off on SLB. So here's the thing. So we've been analyzing these, and we did a whole bunch last week that weren't on this list. But this was a list I came up with ones, and this is not a watch list. I'm making a watch list, and I'm making a watch list. I start off with taking notes. So I just have a notepad next to my computer, and whenever I read a story or I see something positive, or I even if I hear some analysts talking about something, I go, well, maybe he's right. Let me look into that. That's how things get here. Okay, so and obviously it doesn't go there just because I heard someone say something, but I look at it quickly and I say, well, that might be okay. But I'm not there yet. This is only a list telling me what I should be looking at. Then I do a quick analysis, and let's take a look at Booking, BKNG. And here's what I said about Booking. Let's set them up so we don't waste too much time. Booking, BKNG. Oops. Okay, so Booking. I haven't played them since they were Priceline. 1657 is $66 billion, and they're making $4 billion, so it's only 16x. Doesn't matter. The 1667 doesn't matter, except it makes it awkward for most people's portfolios. Now that's intentional. They don't necessarily want you to play. And I mean small investor kind of people. They want big industrial investors to be playing their stock. They don't want people who are going to jump in and out and make a mess of things. They like it that way. A lot of companies like it that way. They don't want to cater to people who are playing on Robinhood or something like that, like older kids. Because, and this because you talk to people like this all the time. But people say, "Oh, that's a good price. It's only $10." That stock. Oh, gee, I can buy. I like it. I like that. I like AMC because it's only an $8 stock and it's cheap, and I bet that's a good price. It'll go to 100 maybe. It doesn't work like that. But how are you going to sit there and explain to people what market cap means and how you have to take the value of the company and divide it by the number of shares and so on and so forth? They don't get that. So many people buy stocks based on the price, and when you're at $1,600, you're getting rid of the riffraff. Basically, you're getting rid of all the people who don't understand how a stock works and pretty much not in the play. So basically, though, we don't care. This is a number, but it's obviously a number that we have to go by. So we're buying it for 1657. 66 billion is what I care about. It's a $66 billion valuation. All right, so there are, you can figure out how many shares there are because you take 60, I'll tell you how many shares there are. This is, you know, let's make sure everybody gets this easily. Okay, so if it's $66 billion, whoop, that's why I didn't even do the 66 part right. 66, 1, 2, 3, 1, 2, 3, 1, 2, 3, divided by 1657 means it's 39 million shares of stock or 40 million shares of stock. There you go. That's the answer. So there's only 40 million shares of stock, which is a fairly low share count. They're making $4 billion. So now that we know there's 40 billion shares, they're making what? What was that number? Oh, I'm such an idiot. I just did that. 66, 1, 2, 3, 1, 2, 3, 1, 2, 3, divided by 1657 is 40 million shares of stock, okay? And they make 4 billion, so they make $4,000 million. So you divide that by 40 million shares, and it's $100 a share. So they make $100 a share. And if they make $100 a share, and the share price is $16.57, then they make, I'm sorry, then they're trading at 16.5 times earnings, which, you know, comes around and goes around, right? 16x. So everything checks back to itself, and there you go. So there's 40 million shares of stock, and they make $4 billion on 40 million shares. They're making $100 a share. That's what matters in a company. How much do they make for the share? You're buying a share for $16.57, and at the end of the year, they're going to give you back $100. Now, how do they give it back to you? They pay a dividend. They put it in the bank, and it's your money. You have a share of that money. It's your money they put in the bank. So they pay a dividend. They put it in the bank. They declare it as profits. They repurchase the stock so that now there's a lower share count than when you came in. That's also a way of redistributing the wealth, right? So, in other words, if there were, extreme example, if there were 40 million shares, right, and you were making $100 a share, if they buy back, let's say they're a boatload of cash, if they buy back 20 million shares for $33 billion, okay, they don't have $33 billion anymore, but it's the same company making the same money and distributing among less shares. So therefore now they're making $200 per share. That's what they've done for you when they do the buyback. And it's obviously not that drastic, but in whatever percentage, that's where a buyback benefits you, because there are now less shares. They're not buying back your shares, they're buying back other shares that were sold. So now you have a larger percentage of the company as yours. And in the other direction, when they sell shares on the open market, when they create new shares, they're diluting you. So bottom line though, there's this. They have $2.4 billion in cash. They have $50 a share in cash. That's nice too, but it's an expensive share, so it doesn't really tip the scales that much. And by the way, whenever I say that, and you can see it here, maybe if I find it there. So, you know, when you're looking at net debt is what matters. Okay, it's like, here's your cash. And there's debt anyway. It's not in here. There's worksheets behind the stuff, but they got 11 billion cash. Net of debt, it's 2.3 billion. That's what matters. They owe $9 billion roughly, and that means they got 2.3 billion of unencumbered cash. That's what matters. I don't get fooled by the cash amount, because what's different is they have 11 billion cash. They have 100 billion in debt. It always matters is a net. What were we looking at? Booking. Okay. So generally they're in good shape. So now, numbers work, attractive company. And do they have growth? Well, in 2018, they were at 14. Now they're at 16. That's not really exciting growth. Profits, flat. Okay, and of course, COVID, blah, blah, blah. But meanwhile, profits are generally flat. They made 2, 2.3, 4, 4.8. You can't tell because this year sucked, but they get back to 14, which is almost all the way back to 2019, and they didn't make any money. Now they're up 16 and they're back to making like this. So I don't really see a real clear path to 5. They're saying next year 5, fine. But look at the number though. What happened? Something happened that they don't make as much money per dollar as they used to. They used to make $4 billion on 14 billion in sales. Now they're making $5 billion on 19 billion in sales. That's not quite going the right way. Again, inflation, salary costs, so on and so forth. So now I say, I wonder how many employees they have. This is all the stuff I do before I tell you yes or no on a stock. So then I go, okay, DKNG. Oh, and Yahoo gave up and went back to their old format. I'm so happy. Back. No. How do I? Get. So they went back to their old format and all the old spreadsheets and everything else. So I'm back to liking Yahoo again. He was so pissed off when they changed it. So what was I saying? Booking. Oh wow, look at that pop. Holy shit. What was I gonna say? I forgot why I wanted. Oh, employees, right? Profile. So you go to the profile page, and they've got 20,000 employees. So, in the grand scheme of things, 20,000 employees aren't going to really impact their earnings. Okay, they're not going to. If you give them all a $5,000 raise, right? So 20,000 times 5,000 is $100 million. It's not going to make it. It's not going to move the needle. So they are an efficient company. They make $4 billion divided by, let's say 20,000. So they make what? That was 4 million, right? They make $200,000 per employee. So that's good. That's right up there with any decent tech company. That's fine. Some guys do better. I think we talked about that last week. I forgot what the numbers were, but $200 is fine. You make $200 an employee, you're in good shape, and you're not going to be heavily affected by, because employee costs are not a major part of your operating costs. That's the key to this thing. Well, okay, it depends what kind of employee. Because if you're an investment bank, then employee costs are half of your costs. They're basically all of your costs are employee costs because that's what you do. They got employees and computers. But they're incredibly highly paid employees. That would not be the case with Booking. Although they probably have more computer people than normal. You know what else I like about them, and this is something I do look at in companies. How much does the boss make? He only makes $5 million. I'm sure he gets a shitload of stock, but that's fine. I don't mind if he gets stock. Okay, as long as it's not outrageous. But he only makes $6 million. He makes $4 million. He makes $3 million. They're not draining their things. This is not a company that's destroying money out the tooth. Nonetheless, in the end, what I said was, the options are too expensive, and that's what it came down to. So I was liking them all the way up until I get to this point, and I say, okay, well, you know what? I do like them. I think they're great. I think they're going to go well. But then I get to here, and I looked up the options. Where is that little elevator? There it is. So I go to 2025, and I look at the options. And they are super duper expensive. And I'm willing to do this once in a while, but you can't have a lot of stocks in your portfolio that are like this because you won't have room. The margins will kill you. So for that reason, and because we already have Expedia, which has all the same benefits and all the same everything else, there's no reason to, I mean, just added Expedia like last week. There's no reason to also add Booking. But it's an excellent stock, as you can see from today's sudden jump, whatever that number was, 3% jump. So it's an excellent stock, but it just didn't make the cut for the watch list. Didn't make the cut over that one last item. Everything else, everything we checked out, okay, great. Everything looked good. Everything was fine. All good reasons. They're in the right environment because, you know, you're looking for travel to come back, right? And it certainly is coming back. Well, every notation we've gotten from the airlines, so on and so forth, even the cruise lines are saying people are coming back and the people are going to hotels and so on and so forth. Even with the inflation, and now don't forget, inflation means high demand, means more money is chasing not enough goods and services. That's what inflation is, okay? Very, very simply, you have inflation because there is more money than there is stuff. And so people bid like an auction for the stuff. More, they say more. They say, what? You don't have enough Cheetos? For $2.50 a bag, I will give you $3 for that bag of Cheetos. I want Cheetos, damn it. That's what inflation is. In a very subtle way, that goes through the entire marketplace, okay? People want more Cheetos than can be manufactured, or the cost of manufacturing Cheetos is another. There's a pull inflation and push inflation. Push inflation is when the price of the stuff that makes the Cheetos goes up and they push the price to you. But there's also pull inflation, demand inflation, and that's because there aren't enough Cheetos to go around, and I want my goddamn Cheetos, and $2.50 wasn't that much money in the first place. And then you have pull inflation. So in this case, we have a combination of both. We have push inflation, pull inflation, but what we don't have is a recession. And a recession is when there is not enough money to pay for the goods and services and prices start crashing. It's not at all the case right now. And money is drastically affected by how many people are working and how many people are not working. And we still have 11 million, and we'll find out next week when we do the next non-farm payroll, still have 11 million open jobs. And I don't see any evidence that anything drastic has really happened to change that in the last month. So we still have probably 11 million open jobs that are unfilled. That is, the entire workforce is 160 million people. So you're talking about, I want to say 10% because it's not 10%, but it's whatever, it's 7%. 11 divided by 160, 7%. So it's 7% of the workforce. And that means that the average company thinks they can be doing 7% more business in the current environment. That indicates that forward GDP growth could be 7%. The Fed doesn't want that. That's going to be hugely inflationary. And the wage inflation is the biggest problem, because once you have wage inflation, the whole cycle just keeps going around and around, because you raise the workers, that makes the goods cost more money, but at the same time, people have more money to spend, so they spend more money on the more expensive goods and services, but then the prices go up again, and everybody wants another raise, and it keeps going, and it's very, very hard to stop. Once that little hamster wheel starts going, it's very, very hard to get the hamster off the wheel. So the Fed does not want to see cyclical inflation move into the market that way. How does this go back to Booking? I forgot. All right. So anyway, so yes. So the travel, so travel is up, airlines up, cruise ships up, hotels are up, and if everybody's going to hotels and everybody's taking airlines and everybody's going on cruise ships, that means that somebody in a restaurant somewhere is selling those people food, and those people are taking home gifts and so on and so forth. So I got to put money on the travel industry. So I got to have Expedia. If I can't have Booking, I got to have Expedia, but they're both good stocks. Okay, right now in this environment, and it's easier than betting on the cruise lines, because those can be scary, and they've got a huge amount of debt that's very scary. Here's Expedia's up 4%. See, I picked the right one because Expedia's up more than Booking is. So, you know, you bet on an individual cruise line, they have horrific debt. And so I don't like that. Airlines also horrific debt, don't like that. Massive, you know, the interest rates are going to start killing them. So Priceline doesn't care, booking. So, you know, they don't care. They're just booking the vacations. They don't care whether the vacation is making money. They don't care if the airline makes money. They don't care if the hotel makes money. They get their cut. So that's what I want to be in. That's the part of this travel industry I want to bet on as a boom market. And on the same thing, they aren't, not that they're not affected. They only made $59 million in, which is very sad for them. They only made $59 million in 2020. So they got there's their cost. In fact, if you say how much of this is infrastructure cost, that's their infrastructure cost basically. That's what it costs them to be open as a service. So, you know, they need, that's their nut. But when they get to $10 billion, they make a couple of billion. So it's almost 50% profit above 7 billion. Almost, not quite, but whatever. Well, it's out of the next. Here's 7, here's 16 or 17. So let's call this 10. So out of 10, they make 40% profit. So they make 40% profit on what above $7 billion. Can they get knocked down to 7 billion? Yeah, but they won't lose money, and that's not true of an airline or a cruise line, right? Those guys lost billions of dollars when the industry shut down. So who should you invest in? I'll invest in the guy who makes money when it goes up, and they don't lose as much money when it goes down. That's my travel bet. Where are we? Okay, so that being said, then we look at Target. We have them in the long-term portfolio. Walmart, they're holding up pretty well, but I think Target's a better deal than Walmart. And, you know, again, going over stuff and looking at all those numbers, so on and so forth. Halliburton. I say getting no respect at $21 billion with $2 billion in profits. So they're trading at 10 times their earnings. They lost, this is always critical, they lost $4 billion in 2019 and 2020. That's total. I should have said that. Not each. So, but what does that mean? That means they don't pay any taxes. They took a huge loss. They won't pay any taxes for the next $4 billion that they make. That's not you're coming in after the down cycle, and if they're not in bad shape, then who cares that they lost some money in the past? It's, you know, if you lost money, like, and this goes for this, well, this goes for the cruise ships too, or somebody like that. But the problem is they lost money and took on debt. So the debt is still a burden around their neck. It's not gone away. In Halliburton's case, they didn't have to take on debt. Or well, they did, but it wasn't significant. They took on a less significant amount of debt, and they are going to make a boatload of money coming out of this, especially because many countries are pushing infrastructure building, which is what Halliburton does. So they got, and I said there's the $6 billion in debt. The $6 billion in debt is what they lost. They previously were a very almost no debt company, a couple of billion in debt before the crisis, $6 billion after the crisis. They will work this off, making $2 billion in profits. Infrastructure spending is in a long-term bull market. There's no immediate catalyst, but as you know, every single person on earth in government is talking about infrastructure projects, and we have to. If we're going to survive as a species, we have to do some massive infrastructure spending. I mean, I can't say massive enough because it's on a scale that has never in human history been done, and that includes World War II and rebuilding after World War II. We've never done anything like this before, and we may never do it. But cost of combat global warming is like 170 trillion or some number. The cost of combating global warming, 131 trillion, blah, blah, blah. 50 trillion, well, depending, I mean, you know, they talk about local, 300 billion, well, 300 billion, are you kidding? Oh, that's somebody with a quiet number. Anyway, trillions and trillions and trillions of dollars each year, and the global economy is only $100 trillion. So you're talking about, I think, 10% of the global economy. Again, in theory, will we do it? That's hard to say. I don't know if we got the balls to do it, but they probably should be spending $10 trillion a year right now, and there's nothing like that happening. We in the United States would have to be spending $2 trillion per year to fight, and that's why you see that number floating around here. We have to spend $2 trillion per year, 10% of the budget. In fact, that's what that is. That's for the US. Well, they're saying it could cost us, and that's true. If we don't spend it now, we're going to spend it later. You're going to have category 6 and 7 hurricanes that are going to wipe out cities where they touch down. You're going to have vicious tornadoes, hundreds and hundreds of them all around the Midwest on a very frequent basis. You're going to have cities like Miami that will be completely underwater. So whatever hundreds of billions of dollars of buildings and so on and so forth, destruction that causes, any coastal city is in danger like that. You're going to have food shortages. You know, it's not good. So either you spend the money now and worry about paying it back in 2100, or you don't spend it now and there may not be a 2100. That's the choice we have to face, and at some point we're going to have to grow up and face it. It's not going to go away if you ignore it. It's like college. You know, you got to go. You're either going to go to college or you're not. If you want to go to college and have a life and jobs and so on and so forth like that, you need to start putting money away now. You need to do something about it, or you're going to go into debt. It's not like college isn't going to happen. There's a fixed date. And if you don't do anything, you will have to borrow your entire college education cost, which these days is several $100,000. If you even the less expensive colleges, a couple $100,000 in debt, you can come out of school. So either you don't do it, and then of course there's many statistics that will say your lifetime's earnings are going to be impacted by millions of dollars, right? Or you're going to pay for it and be in debt, and then your earnings will be impacted by also millions of dollars because you're spending so much of your energy paying back debt instead of building your wealth. They're choices that you make, and we have these choices now. The problem is you don't have an educated enough population, or I mean, there's too many people who just don't believe stuff. And even if you show them the facts, they don't believe it. And this is where we are. We're like, it doesn't matter if it's true. Nobody wants to do anything about it. There are people who are what they call deniers, and the fact that it's happening. This is like denying the fact that you have 2 children and they will have to go to college one day. You can't just say it's not going to happen. It is going to happen. It's a fact. Whatever bullshit you think is going to happen that's going to make it so they don't have to go to college is not going to happen. And you will be screwing them over, just like we're screwing this planet over, in an irreversible way by not planning on it now, by not taking care of the problem now. So whatever. We have to start doing stuff now. We have to do drastic things now. We're starting. We're not doing nothing. You see the solar plan. You see Biden's things. You see other countries, doing all this crap. But it's not enough. It's nowhere near enough. We need to be doing more. And then the problem is, of course, if you start doing too much at once, you end up wasting some of the effort, right? And then everybody then the other side says there shouldn't be another side. That's the problem, because the other side immediately starts pointing fingers and going, look at how wasteful that is. They did this wind project and the wind project is in the wrong place and now it's not producing what they thought it would produce. Therefore, we should do no more wind projects anywhere ever because that one didn't work. Which is like saying if you build a gas station and it doesn't get a lot of customers, we should stop this whole concept of gas stations. It makes no sense. There's no logic to what they're saying. It's not supported by evidence. It was just that particular thing in that particular place was not the best use of funds. But the more you push and the more you try, you're going to have more and more things that people can point to. Like Obama, when he did those solar incentives, right? He had like 1 or 2 things one or two projects went bad, and they basically attacked the whole program because one or two projects went bad. But meanwhile, there were dozens and dozens of very successful projects. You know, and we got totally off track from that shit afterwards, which is a shame. So, you know, we all have to do this together, and it's a lot of money. It needs to be done, but it also will be done, because even right at the end, you know, like Rome, when the barbarians are at the gate, suddenly everybody says we should build up our city defenses. It's a little late, but at least now they see the light, right? And that's what it's going to be. It's when you see cities crumbling into the water, when you see a hurricane, when they have to add category 6 to hurricanes, and Houston gets wiped off the map or something like that, then all of a sudden everybody in Texas will go, oh, this thing might be real. We should probably do something about it. But unfortunately, long before that, you know, we have these specifications for buildings and specifications for oil platforms and specifications for all sorts of things that will cover you up to a category 5 storm and even a strong category 5 storm. But when you start having new categories of storms, nothing is specified for that. And logically, it doesn't make sense to build a building to withstand 250-mile-an-hour winds when there's no such storm. You'd be overbuilding. But that's the kind of crap that's going to happen. You're going to have situations that just could not be conceived of before. You're going to have temperatures. You know, you have a building that's designed to be cooled to 75 degrees. Even if the temperature outside is 105, it's going to go to 75. But you didn't plan on it being 120. It's just no longer possible to keep the building at a reasonable temperature. Once that happens, you've crossed a threshold at which the design of the building doesn't meet up to the environmental conditions outside. Not to mention our aquifers, our water systems, our you know, all these projects. You know, one of the problems we have with the damming system is evaporation. As you have more and more hot, dry days, more and more water is evaporated out of all these dams and reservoirs and so on and so forth, and they start drying up at a much faster pace than anticipated. That, plus the additional downstream demand from all the farmers who have parched farms and so on and so forth, it's a complete disaster, and nobody coordinates it nationally. Why doesn't anyone coordinate it nationally? Because half the people don't even believe it exists. How are you going to have a national coordination? How are you going to have a water czar if people don't believe there's a water crisis? How do you have a strong federal government take control of these things if half the federal government doesn't want to even admit that it's happening? It's crazy. So anyway, so Halliburton, good choice. There's going to be infrastructure. Whether one way or another, there will be more infrastructure spending. So in the LTP, even so, in the LTP, I said, you know what? We'll sell the 2025 puts for $7, and that puts us in for 18. And Halliburton's at, did we ever get a number? Well, whatever. So Halliburton's at $24. And we're going to sell the $25 puts for 7, which nets us in for 18. Oh, I read that. It's 25% off the current price, which was 24 yesterday. So our worst case scenario is we get assigned Halliburton at 20. Now, again, it's not, when you say off the current price is already cheap. That's why we're looking at them in the first place. So, default list, show me a stock. Go. Gallery view, Halliburton. Yep, down here. All right. So in the near term anyway. So they're already down from 40 to 24. In the longer term, 24. This has been a pretty well-established middle range for these guys for a long time. So I'm glad to get a chance to get in there at this price. You know, can they go lower? Sure, they could go lower, but I just want more of them. We're paying 18. We're down here. We're netting in for 18. I'm not willing at this spot to say, oh, they are definitely going up from here, but it is low enough and the puts are attractive enough where I'm going to say, okay, you know what? I'll take an additional 25% off to 18 and we'll see what happens. So either we're going to get, either it goes up and we end up keeping the money for the puts, which is fine, or it goes down further and then I get a great price on my bull call spread and we go forward. So that's all. That's putting something on the watch list. That reminds us to keep an eye on. Ooh, Clay says try screen. All right, let's take a look at this. I'm always up for these things. He says there's some kind of cool try screen. Gets my attention right away. Instantly add 2 laptop screens. Go away. What am I doing? Oh, that's cute. I like it. I wonder how big those are. That's kind of nice. I have 2 LCDs though. I don't know what that costs. Shop the try screen. Okay. Well, sell it to me. $500. That's not bad. Honestly though, I have an LCD like this and an LCD like that, and even so, that's all this is. It's really just a way of taking 2 LCDs and putting them together. But these LCDs are only like $200 or less. So it's honestly, it's just a cute, it's a gimmicky thing. Because if you just plug in an LCD on each side of your thing, they'll work just fine. And I have the LCDs that like stand up on their own, and they're bigger. That's what bothers me about it. But design-wise, I love it. It's great. Do they have bigger ones? No, it seems to be just a one thing. Well, down the road though, if they make a better design on it. See, to me, I would go with it. I would have gone with something bigger that touches the floor. You know, that hits the laptop. Is I don't know. Maybe they can't tell where it's going to be though. Make it adjustable like that. But yeah, it's convenient. Look, LCD laptop screen. LCD. Well, LCD screen. What? Portable. Not describing it properly, I think. Portable. Because there's lots of them. It's not like it's a strange thing. Oh, there's that thing again. Oh, see, there you go. That's more like it. LCD triple portable monitor. Side tech. Oh, see what I mean? So that's $289 for that one, 16 inches. What is this though? Two attachable that enable expansive triple screen. Okay, so you're still sticking on 2 things. Those are not that big though. They're just using, that's cheating. They're using a small laptop. They got 12.5 and 14 inches. That's what I got, an Asus. In fact, I actually have that. There you go. See, 16 inches, nice little thing like that. Very simple, and it's $200. There you go. See, I remembered. I'm very happy with it. Very durable. Haven't had any trouble at all. If even for like for this kind of stuff, with the charts constantly moving, it seems to keep up no problem. Doesn't drain out the batteries. I mean, everything about it is fine. It's all good. Very happy. See, that's it. Simplest thing in the world. Portable monitors. See, lots of them. You can go to Best Buy. They're just sitting around. They got plenty of them. And so that's a game changer though. Taking one of these with your laptop. They don't have their own power. They have a plug that goes into your USB port on the laptop. But that's why. So when I went to get my new laptop, of course, it had to have multiple USB ports. That was the most important thing to me. I'm like, gotta power my screens, otherwise, what's the point of this whole thing? Laptop was surprisingly cheap too. All right, so going through the process, right? Walmart, that's where we got to, and we were looking at the whole thing, and we had a list and what happened. Oh yeah, right, it's on here, GNRC. There we go. Back to the list. So, Schlumberger is probably the same as Halliburton. They're very, very similar companies, very, very similar everything's. Maybe they're, see who's a better deal. So who has less debt? So Schlumberger is $35, $48 billion, $3 billion a year. It's not as good as Halliburton, actually. Was it? No, Halliburton was more money. That's right. Sorry, it is a better deal than Halliburton. So they are only 13 times earning. Halliburton was 16 times earnings, and that's 13 times. See, that's 13 times 3. They're moving to 4. So they're, and again, is 4. But when you see that, is it realistic? Well, when they were making 31 billion here, they were only making 2. These losses are horrific. So they're out. I can tell you right now, they're out. I don't care what their reason is for losing this kind of money, but the fact that they can lose that kind of money is horrible. Plus, I guarantee their debt is staggering. Yeah, their debt's $11 billion. So compared to Halliburton, that's a complete loser. Okay, so they're out. And that's good. It's good when you get somebody out quickly. They're out because we already found Halliburton. We like Halliburton. What do we need them for? MetLife. All right. Now we go to MetLife. And we look $48 billion, $48.5 billion. Nice, $5.8 billion in profit. That is consistent with what they used to make. Well, don't know what happened there, but 4 billion, 5 billion, 5 billion, 5 billion. Okay, very nice. Still the same sales, still the same money. Allow for, give them a break, inflation, fluctuating dollars, so on and so forth. All cool. All right. Interestingly, I'm surprised because we have lower life expectancy. COVID, do you know this? I mean, COVID knocked a couple of years off everybody's life. U.S. life expectancy. Wow. 76.1. That's down from like 79. Where is it? Where is it? Who's going to show? Oh, there you go. Look at this. Look at this. How awful. Here's it. I'm a guy. I'm sorry. You ladies already had it good. 79 years old, 76 years old. 3 freaking years knocked off our lives by COVID. That's hard. That's going to be hard to get back. Look how long it took us to get to here. It took us 20 years to make progress. And now we lost it all in 3 years, or in 2 years. How's that for devastating, right? Oh, that's not even males. That's both. This is males and females. Here's the gap between males and females. 76, 81. Wow. That's awful. So yeah, for us guys, we're lucky to make 77. Now we're down to 73. So that's really, is that right? Yeah. Ooh. That is 4 years, but it's 4 out of 77. It's 5% of our lives. That is really unfair. And you know what's really unfair too? MetLife, because MetLife has been collecting insurance money from all these people. And for all these years, they've been saying, well, you know how much we're going to have to pay out? We're going to have to pay out this much. They're going to live this long, blah, 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 right? They thought that they would have 4 more years before they pay these people out. But all of a sudden, they're dropping like flies. So that's not good for life insurance companies, but it doesn't seem to be bothering them. Fortunately, especially though, companies like MetLife have to hold a tremendous amount of annuities in reserves. Look at that. See this net fixed assets? So all this money you pay them has to be, there's actuarial tables and such, so they determine how much money they're going to need each year to make payments. Now, what they've had to do because of COVID is ratchet up their expectation of how much they're going to be paying out in the next few years. Fortunately, though, they are legally bound to have this an extremely conservative sort of thing. So you see how this money suddenly popped out of here? Look what happened to them. So $100 million, not 100 million, sorry, $100 billion, $100 billion of their reserves has been drained since COVID started. So that's not good. Now, they don't have any debt. They have $3 billion of cash net of debt, but $100 billion of their reserves disappeared. But they were collecting. Here's the good news, though, is MetLife was getting 2%. They've got to invest this money in very conservative stuff. So they had 2% of 748. So we'll say 749 times 0.02. So they were getting $15 billion towards paying out claims. And had not this horrible thing happened, this would have probably continued to grow, right? But they had $14 billion to pay out claims, but suddenly because of COVID, they're paying out life insurance and health insurance and all this crap all over the place that they hadn't expected, plus the disasters from global warming, more money for that too, for home insurance and everything else. But luckily, remember $15 billion. So luckily though, $653 billion times 0.06, they start getting 6% interest. It's $39.18 billion. So all these life insurance companies have been, all these insurance companies that were required to manage to hold these reserves in order to make payouts down the road, as it should be. There's nothing wrong with that rule. But because they have to manage these huge pools of reserves and keep them conservatively invested in bonds and T-bills, things like that, they were never able to capitalize on this huge amount of cash they have sitting around. Now that interest starts coming back and they can make huge interest, it doesn't matter that they've got less money. They're making so much more money that's going to go towards these payoffs. So they would have been in trouble as the reserves began to drain, but it's been completely offset by the rising rates that they're going to be able to get for the reserves that they do have. So I don't think they're in trouble. People have treated them like they're in trouble. Although not really though, right? Because I mean, they're not really suffering as far as the stock price of fluctuation. So they aren't deathly cheap, but I don't think they're ever going to be cheap because they're only trading at 13 times earnings now. And those earnings are going to go up in the immediate time. The after effects of COVID, long COVID is still going to keep people less healthy than they were, but it's going to come back. You know, a lot of that change in the average age expectancy, in the average life expectancy, is caused by the fact that how many people died now? How many COVID deaths? Total U.S. COVID deaths. A million, yay, we passed a million. Okay, so when 1 out of 300 people lose, let's say 10 years off their life, right? Let's say it mostly affected old people and they only lost 10 years. You're still looking at you're still looking at knocking the average down quite a bit for everybody. It's well, it's 1/30th and 10 years, so it's about a third of a year or so. Or yeah, so figure maybe a year's knocked off everyone's life by the actual deaths. That's going to go away, so life expectancy will tick back up 1 year probably, and then the long COVIDs will go away. That'll tick us back up another year. People will not be as affected, hopefully, and again, hopefully that's where we are. We're still having can you believe 455 people? 445 is still dying every day. That's shitty. Still 440. See, we can't get the deaths down. The infections are down, but you can't get the deaths are really holding up. You know, and it doesn't, you know, 445 a day times 365 days, 162,000 people are still going to die. That's rotten. But anyway, we've already had 1 million people die in the United States of COVID. 95 million, 1/3 of the population has had COVID. And that's reported because, frankly, because of the vaccines, you get basically a mild case of COVID. Nobody even bothers reporting it. They don't do anything. Most people don't do anything, especially people, the 1/3 of the population that doesn't even believe it exists. Obviously, don't go to get tested to see if they have COVID when they have a bad flu. They say, it's just a bad flu. So that, anyway, MetLife. So good rock steady stock. Really a contender for the butterfly portfolio, but then do I want it in the butterfly portfolio? Then I have to say to myself, well, okay, how is it for selling long-term options? So I like Met. I don't think they're going to go rocketing higher, but I think they're going to be a good steady stock, which means I want to be in the money. They're at 61, so let's say we sell the $60 calls, and those are maybe a little less than 12 bucks. What if I sell, what are these, the 60s? What if I sell the 65s? Those are like $9.50. All right, let's say we sell the 65s for $9.50. And then what's going to be $19.50? Probably these guys. Well, the 50s are going to be less. It was last 1670. The spread is 1570 to 1980. That's a $4 spread. That's a big spread. 17. You got to be able to get more than 1670 from that, especially on a big up day like this. So I'm going to say 17. Let's say 1750. Let's say 1750 for these, and we sell the 65s for $9.50. That's a net of 8. So you're paying $8 for $15 spread that's already in the money, right? It's only at $62, it's barely out of the money. So you're going to pay, what did I just say, $8? $8 for the spread, and then let's sell something to cover it. And since we don't really think MetLife should be any lower, we can get pretty aggressive with the sale. Let's say we sell the $50 puts. That's not even that aggressive, but we can sell those for $6 or $6.50. Or we can sell the $60 puts for 10. Oh, I think I'd rather do that. I'd rather sell less of those for 10. So let's say we sold 5 of these guys for 10, right? And that's going to be 5,000 bucks. And then if we buy 15 of these, it's going to be 12,000 bucks. So the net would be $7,000, and you'd have 15 of the $15 spreads. So that's 1,500, times 15 is 22,500. So we'd be spending about $7,000 on a $22,500 spread. There'd be $15,000 of upside and all it has to do is go from 62 to 65. And it's a 15, so it's a 200% upside basically on that. And that's a small obligation. You're only obligating yourself to buy 500. And we do it like that. So anyway, something like that is what I would put up for play. I'd look for something maybe a little bit better leverage than that. I like to try to get 300% out of my trades if I can. But I want to leave room because Met is and here's why. Okay, this is the point of doing this lesson, right? So here's why, because Met is not that low in the channel. Okay, we could have a lot of floods. We could have some more disasters. We could have a resurgence of COVID, and they got knocked all the way back to 20 in COVID. And that was out of pure fear, though. But they trade in the 30-40 range. And if they come back to the 30, 40 range, I want to be able to add and keep in it. I don't want to be kicked out of it just because it goes to that. If I start planning too much, if I put too much in now, I'm not going to have the money to double down and roll later. But I do like it, and I like it in my portfolio. I think it's going to be an easy win. So that's the way we look at it. Capital One financials. Now, another thing about this is, of course, I'm looking for things that I think fill a gap in the portfolio. So, we don't have a lot of financials. I like Capital One, and I thought they were pretty well priced. So we look at Capital One. Yeah, this is kind of crazy. So 95 bucks, $35 billion. I mean, they make $7 billion. They made $12 billion in 2021. They had a good time last year, 2 years ago. Before COVID, 3.72. Now they're a little erratic, and I'm not sure why. Their top line's not erratic. Their top line is steady, slow growth. The bottom line tends to be erratic. I don't know why. I'd want to look into that more. That's one thing I'd have to research. Why would they suddenly go down? I mean, probably they go through investing cycles. Okay, they make plenty of money, they do some investing, they make more money, they do some investing, they make more money, and now they'll probably do some investing. But that means also, per their pattern, they are very likely to probably spend money and do some investing over here, and they'll go down. I don't know how the market reacts to that kind of crap. So let's take a look at a all-time view of them. Yeah, that's all right. Well, no, 5 years enough? Not quite. So what happened in 2020? Oh, look at that. No. See, the market does not like it when they go to do their investing cycle. Of course, that was just 2020 when everything crashed. What happened? Oh, you can do this with this chart. How nice. So what happened in 2017 when they went into an investing cycle, presumably? And what happened is they went from 92, really not a big deal. It was taken in stride. So they did not get punished for this. So whatever it was excusable. This, everybody went down, so you can't go by that. Okay. Anywho, so 2021 now, probably whatever it is in 2021 was probably an unusual situation. They probably realized the gain, they spun off a unit, whatever they did. So, all right, stop that. All right, okay, if I touch it, it makes things. So that was unusual, so I throw that out. So, this is unusual, throw it out, that's unusual, throw it out, and they're pretty much on track then. 6, 5, 7, 6, okay, $5 or $6 billion. Let's call it $6 billion against 35 billion is a low number. 6 times 9, 35, yeah, it is, isn't it? So basically 9 times. I don't know why that says 5 times. It's a weird thing. That's why you always got to do your own math, because you look at these things, you have no idea where they come up with this number. But unless I'm wrong, I am wrong. It's 5. 5 times 9 is 45. I'm sorry. So 35 divided by 6 is 7. Oh, 6 point. All right, it's 5.8. So 6. So 6 times earnings is silly. How much debt do they have? Oof. 43 billion in debt. But again, huge, now these are bank reserves, of course. They've got to figure out they make their money by loaning those and doing other things. Net debt, it's different with a bank, so you have to understand how the dynamic is. But the bottom line is still, they're going to pay a lot more interest on that debt. 5% of that is going to be $8 billion. No, $2 billion. Sorry, $2 billion. So 5% is $2 billion. That's a third of their earnings. And we don't know. And again, now research again, because now we don't know whether or not they've accounted for that in these numbers. And they may have or they may not have. We've been assuming everybody hasn't accounted for them, but when it's a number like this, I got to see whether or not they've accounted for that number. We have to get that off their next report. So this is a wait and see one for a couple of reasons. It's going to be a wait and see. Why are they so erratic with their earnings? Have they accounted for higher interest rates in this number? So it's possible that if 1/3 of this is bullshit, I'm sorry, we're already at 6, and if 1/3 of it's bullshit, their PE could be 9. 9 is still not terrible. We can live with 9, but where will they settle? So I think we'd have to wait and see what the earnings look like for the next thing. Hopefully they're terrible, and hopefully they make some bad announcement and go down here, because then I'd start liking them more. I would love them if they were in the 60s. They're probably a good deal here, but not without being sure and triple checking, why they're down here. There's them, SYF. We can. Another financial. Also down. Oh, you know what I like about them? Oh, this isn't Signet though. This is Synchrony. I was thinking of Signet. Signet Bank I really like because they're becoming the bank of choice for Bitcoin trading and crypto trading. They've done a really good job of securing those things, and I just had an article today about $2 billion worth of Bitcoins have been stolen this year. You're going to need banks, which kind of destroys the whole concept of why you have crypto in the first place. But if you do have crypto and you don't want it to be stolen, you need to put it in a bank. Oddly enough, you're not capable of protecting it the way a bank is. So I like Synchrony. I don't remember why I like them. I think it's just numbers. $13 billion. Oh yeah, $3 billion to the bottom line. Well, declining, so we don't know exactly, but it looks like a pretty steady amount. You can expect 2.5 is easily to be held up based on the fact that their revenues are holding up. Not a lot of growth though. Not too exciting, but it's a great PE. No debt, not no debt, but not enough debt to worry about. They're in good shape across the board. Don't like the fact they're not growing. That's a big negative. But otherwise, they seem like they're in excellent shape. So that would just come down to so then we want to see what the payoffs are. So 28.91, we could sell. See these wide spreads? Oh, these wide spreads indicate that they're very thinly traded. You want to look over, so then I have to look over here to see what even these are really wide spreads. So I can only get a read over here. It's about $5 for the 28 puts. Probably going to be $6 for these puts, maybe $6.50. And do I want to sell that? Yeah, that's fine. So I would sell those. I would sell these for $6.50, the 28s. That would net you in for what, $21.50, right? So if you sell 10 of those, you're obligating yourself to buy $28,000 worth of the stock, which is no big deal in the long-term portfolio. And then we compare that with, again, the wideness, but these are not so wide. So 570, 690, let's say 625, something like that. Let's even 650 if we pay 650. So let's say those are 650, and the 40s last went off at 482, right? Is that last? Yeah, that's last. So the last went off at 42. These last went off at 348. All right, so somewhere in this range, we should be able to get like at least $4 out of these. And if that's 650 for the 30s, and the 40s are $4.50. It's only net $2 on a $10 spread. There's nothing wrong with that, right? So if we're selling on the other side, puts for, I forgot the number. What did I say we're going to sell? The 30 puts for like what, $6? So we sell the 30 puts for $6, let's say. That means for every put we sell, we can buy 3 of these spreads. That's a good deal. So if we sell 10 of these for $6,000, I think I had a different number before, but let's just say we stick with that. If we sell 10 of these for $6,000, and we take the $6,000 and we buy 30 of these spreads for $2, we're in great shape. Then we have 30. Then we have $30,000 worth of spreads, then minus the puts and 10 puts, and it's net zero. And so the worst thing that can happen is we end up with $28,000 worth of stock, which is the current price of 1,000 shares. So worst case, we own the stock as if we bought it today for 1,000 shares. Best case, we make $30,000 freaking dollars and we never own the stock. If the stock is over 40, that's where we're going to be. So great trade. Hopefully the bank grows. P so low that if they manage to hold these numbers, at some point someone's going to start noticing them buying them. So there's a good one. Okay, so Allstate's more insurance. THC, Tenet Healthcare, it's going to be the same as Met, so let's not be boring, right? THC is Tenet Healthcare. Sounds like marijuana, but it's not. THC is any hospital. I mean, come on, how good could the demographics be for hospitals? Look at all the people who are dying. Look at life expectancy, right? Those people have to go to the hospital. They've again, it's short term, really bad, right? Half, almost 50% drop. Long term, though, they're fine. I mean, so what? They went a little bit high, and now they came back down to a more normal level. I'm going to get through this one. THC. They're only $5 billion company. They make $700 million. So the PE is what, like 7, 8, whatever. Does it make sense? Well, very, very little growth, right? You know why? It's a hospital. They're at full capacity. They're not making more buildings. There's reasons for that. There's not much growth to this sector other than inflation, but inflation is a thing unto itself. The hospitals will pass on those inflationary costs, and they will get approved because the government agrees that inflation is running at a certain rate. So they'll up their insurance payouts to the hospitals, and the hospitals will make more money. And not only that, though, but don't forget, a lot of what the hospitals charge for is service, like their rooms. So when they ask for a 10% increase, they get a 10% increase. There is some stuff that costs them more money, but nothing like the markup, of course. They're charging like $25 to have an aspirin. So maybe the aspirin costs more money for the hospital by 15 cents, but they're marking it up another $1.50 to the healthcare providers. More importantly, though, they're marking up the labor costs, they're marking up the nurses, they're marking up the machines that they already own and servicing those machines, and they're marking up the rooms, which is their main business. It's a hotel. A hospital is a hotel that you pay $3,000 a night to share a room with somebody, to share an awful, uncomfortable, beeping room with another person. That's with a tiny little TV. It's so ridiculous. Anyway, so they've got a lot of debt, but they're in the business they're basically a REIT. They're like an apartment building, right? A hospital is just a purposed apartment building. And it's got doctors, and they do doctor stuff in the hospital, but that's really got nothing to do with the hospital, okay? The hospital provides equipment. The doctors use the equipment, pay the hospital for their use of the equipment. The patient does anyway. But the patient pays the doctor a certain amount, they pay the hospital a certain amount, and your bill says, here's what you pay for the machine, here's what you pay for the disposables, here's what you pay for the nurse, here's what you pay for the room, here's what you pay for this and that. Everything's got a price, and the hospital itself employs the anesthesiologist. That's their employee because they sell him for a fortune. You know, they don't want roaming anesthesiologists, and obviously an anesthesiologist can't roam. He has to do his services in the hospital, so they get tied to a hospital. You know, and the doctors are the ones that roam. They could choose different hospitals, but they tend to affiliate themselves with one certain hospital that they send all their patients to. And anyway, so inflation is going to be nothing but good for these guys. It's going to allow them to raise their prices, which is very hard for them to do normally. But because even the government is going to recognize the prices will go up, it'll be good. Unfortunately, this debt's going to go up. 5% of 13 is what? $750 million? Is that right? 1,321 times 0.05, $600 million. So sorry. So 700 million, well, 700 million. $700 million of additional is going to come off this. Oh dear. Oh, that's not enough money. Wow, they need those. They need those price increases. You would think hospitals do better than this, right? No, that's no good. So they're out. Yeah, it's as you go through it, you got to keep looking at all the different facets. And now we found a roadblock here. No, 5% more interest on $13 billion is $700 million. That's all of their profits. Okay. Now they could raise this, but I don't think that raising this 10% is gonna increase this enough to offset the increase of that, and it's too risky. So it's not worth the chance. So sorry, THC out. That's surprising. I like THC. We have them in the portfolio, in fact, and that's probably reconsider that. Anyway, so hopefully now you're getting the idea. I'm not going to go through all these. We're going to do the rest on in the chat. But that's the process we do to go through these things. And in each one, we're also thinking about what is the macro environment like? Where are they going to be? Is it a good time or a bad time to be in this sector? Look at Delta. Put Delta there. United Health Services. Hopefully they have better numbers. Good old AT&T. And then we have to look at Verizon. If we're going to look at AT&T, we're looking at both of those. Comcast. T-Mobile. Lots of things to look at, but Middleby. I love Middleby. Whenever they're cheap, I like to buy them. They make Viking. They're a Viking company. They make outdoor ranges, grills, professional restaurant stuff. And again, been a very, very bad time for that industry. How badly did Middleby get affected by COVID? Since a lot of their business is fitting restaurants. You know, the cooking equipment for restaurants. Not too bad. Sales dipped a bit, profit dipped a bit during COVID, but it came right back. So basically these were orders that were put off. Okay, so people put off ordering stuff, but then they went right back and said, oh, no, we guess we need a new stove and whatever. Not only that, but the government paid for it. That was probably helpful too. But look at this nice jump they had. So 2.2 to 2.9. So that's up 7. Well, yeah. So that's up 30%. In 3 years, all right, and then 30% of this is another billion, so we should be at about 4 billion in 3 years, and we made it. So they're on track. This kind of fluttered their growth, but nothing bad. They're on track and looking exactly like they should look with this kind of growth. So again, like I said, I love these guys. So any chance you have to buy them when they're cheap, you take it. Where are we? Wow. Yeah. So for no good reason, they're below. Although, you know, 129, that's, again, like I said, it's a problem when they're expensive stocks, but that's okay. I doubt they did much from the debt. They've grown, but they've added a lot of debt. $2.5 billion times 5% is 120 something million dollars coming off this. That's a big chunk, so they're going to lose 20% of their revenue here. But that's still going to be dropping over 400 to the bottom line, and the valuation is 6.6. So we're talking about 15 times earnings roughly. That's fine, and they'll grow back out of that. And they've expanded, so it's not like they wasted the money. So I think that's all fine. I'm not too worried about it. They got good heads on their shoulders. I mean, I've liked these guys forever. I've liked this, one of the first stocks I ever picked at PhilStockWorld. So that goes back to 2006. This was one of my top companies. I wonder where they were in 2006. Oh, look, we can find out. They were like 15 bucks. It's funny. Wow. See? I know what I'm talking about. This was one of my favorite stocks when we started PhilStockWorld. I remember that. And nobody had ever heard of them. I used to have to keep explaining to people what they do. You know, I like them because I'm a big Viking range person. So I mean, I like my Viking range. But also I found out that they make all this really great restaurant equipment, and they're basically the tops in the field. Now, they're subject to like steel costs and things like that, but we don't have a shortage of steel. We just have expensive steel, and they pass that cost along. It's not a big deal. So I definitely like these guys for a long-term play. And then I would look at the options. I know they have good options. Oh, they only got till March. Damn it. That's a shame. So stock like this, I really need to, you want to pick them up when there is a catalyst. So I would have to read something that would strike my attention in the paper to say I want to jump on that. But 128, they used to have better options than this, I think. So let's say that into March, we don't really think there's going to be huge downside. So if you sell the 120 puts for $10, you're netting in for 110. 18 below the current price is a 15% discount to where we are now. And that's a fine place to start. And then if you end up getting assigned or it comes too close, you just roll them. By that time, there'll be more options. You can roll them down to a lower price. But I would start there. And then if I happen to read something that says, oh, Middleby's doing something kick-ass or something good's happening for them, or they sign a big contract with McDonald's or whatever, then jump in and buy some more, then buy the puts and calls. But when you see short-term thing like this, it's just perfectly fine to just make the money on the puts. Sell 5 of these things, make 5,000 bucks, and see what happens. Just reminds us to keep an eye on it. And Ken says, what about Weber? Oh, Ed says, what about ISRG? All right. I think we have ISRG somewhere. If we don't, we should. I always like ISRG. So what about Weber? I think the bottom line with Weber, let's start with that while we're here. I think the bottom line with Weber is I think Middleby better. Weber is not really the commercial grill thing. It's really a home thing. So if you think the consumers are taking a hit, an optional item like a grill is not the first place I would look for consumers to be sticky. They're a $2 billion company. They're not making very much money at all, 20 million bucks. So they're trading at 100 times earnings basically. It's too unstable by comparison. It's not, and look at that debt, 1.2 billion in debt. They're only a $2 billion company. So no, that's the reason Weber is not there. I usually look at the competitors when I'm picking these things. So I probably have already looked to see if anybody else is good. Now, ISRG is a thing unto itself. The model of surgical robots makes so much sense, and what's happening. Wow, look how cheap they got. Okay, good. So here we got $200, $66 billion. They're only making, see, that's the problem of the multiples too high. They're only making $2 billion, not even $2 billion. So they're at 30 something times earnings. They're already priced for tremendous growth. Look at that though. They got 4 billion net cash. So if it says 33 times earnings, see 35 times earnings, take 10% off that because they've got 10% cash on the books. Still, unfortunately, the good thing about ISRG is that right now, I forgot we ran the numbers on this recently, so I know we have ISRG somewhere because I ran all the numbers and we were looking at where they are now versus where they can grow to and so on and so forth. And so I have a whole huge thing in chat somewhere about everything to do with ISRG is already laid out. But what we looked at, and I drill really deeply when I get into these things, is you're looking at what percentage of doctors are currently trained to use ISRG machines, and then you look at how many surgeries are being performed in various countries using ISRG, and the huge growth is China. China is really readily accepting this stuff because they're such a big spread out country and there aren't that many specialists in the rural areas. It's not like America. Like in America, we kind of have, if you're in the Midwest, then you're going to go to Chicago and get something done. And China doesn't have their cities on a spread out the way we are. They don't have a Chicago and a Houston in the middle of the country. Kansas City, there's always a few places, no matter where you are, where you can fly somebody for operations. It's not so much like that in China. It's really all the big doctors are in the cities, and all the cities are kind of mostly on the two coasts, on two sides of the country. Very little in the middle, in the rural areas, and that's a problem. A lot of Asian countries have this problem. A lot of, all over the world, people have these problems. Obviously, we have these problems in certain areas. The machines make a huge, huge difference because they can perform. This is the thing, they get certified. So the machines that exist now get certified for more and more types of operations. The machine can do a lot of stuff. It's like a doctor, right? You can train a human to do all sorts of things. You can train the machine, which is run by a human, to do all sorts of things. So what happens is there's a certification process that you will now allow ISRG machines to do these kind of operations. And once you do, then you have a cycle of having to train the doctors, more and more doctors, to use the machines for these type of operations. So as you know, everything's a specialist, right? So if you suddenly say, okay, an ISRG machine can do a prostate, a prostate surgery or something like that, maybe then now you have to train prostate doctors to do it, and they may have never been allowed before. They've never been certified, or their specialty has never been certified before. And meanwhile, some other specialty has got 40% of the people who know how to do it. But anyway, so there's huge growth in emerging markets like China. There is huge growth in the number of doctors being trained and the number of procedures being approved. And ISRG is like selling razors and razor blades. Every time there's an operation, there's a ton of disposable income from them, and also maintenance contracts and so on and so forth. Imagine how mission critical one of these machines is in a hospital. A hospital can't even afford to have one. They basically have to have at least two. They have to have a backup machine. They can't afford for this thing to be off because they've got 20 surgeries a day scheduled, like one every hour. As soon as somebody's done, they bring in the next person and free up the machine. They are running these things all day long, and they cannot afford any downtime whatsoever. ISRG collects a fortune, and it's growing and growing and growing. Wonderful, wonderful company. I love them. It's another one that I've liked since day one. And in 2006, they were, oh my God, they were $12. Now, I stopped liking them when they went up here. When they got into like the 200s, I was done with them. Then they went to 400, and that was ridiculous. Now they're back to 200, and they've gotten bigger. So I feel better about this price now. You know, and I would certainly consider them. But again, it's another heavy stock. When they're a $200 stock, if I sell 5 puts, I'm already making a commitment to $100,000 worth of stock. So, and even in the long-term portfolio, I don't want to have that many $100,000 blocks that I've committed to. So just to sell 5 short puts, that's a big commitment right there on ISRG. I do love them and I do respect them, but they aren't at crash prices where I say I don't care how much it is, it's irresistible. Okay, $100, I would say I don't give a shit how much. You know, it'd be $100. Like I would absolutely have to do it because I couldn't stop myself. I would have to, you know, something. You know, look, if you see a Toyota a Camry and it's $35,000, you say, oh, that's a pretty good price. They're usually like 40 or 42. If you see a Toyota Camry and it's $20,000, even if you didn't want a Camry, even if you weren't looking, you say, holy shit, a brand new Camry for $20,000. I'm going to find somebody who wants it. You know, it's a different thing. So when stocks get to a certain price, they are completely irresistible. Like here, like whatever. When was this? Oh yeah, this is 2020. Okay, so this is 2020. So you can see here, 135. Obviously, people jumped right in and bought it back, and then they went crazy. But 135 was the stopping point. So if it gets down there, I'd have to say, okay, that's when people jumped in hand over fist. I like it. But meanwhile, that doesn't stop me from saying on ISRG, so we said 135 was the least, right? I don't have to sell the 135 puts. I can sell the 150 puts for 20 bucks. That nets me in for 130. I'm collecting 20 bucks. So if I sell 5, I get $10,000 for promising to buy ISRG at net 130. So, you know, I don't have to wait to get into the stock. If I think this is a good bottom for it, they are, like I said, they are expensive as far as like being 30 times earnings. But on the other hand, they are absolutely going to grow into it over time. So I don't think this is a bad position. I also don't think, though, that we probably need it in the long-term portfolio. So given that, I'm probably not going to add it. I'm going to give it some more thought, though, okay? Again, I don't want to overload because God forbid we actually have a recession. That's what we need to talk about now. God forbid we actually have a recession, then we're going to be screwed. Every single position we have in the long-term portfolio is going to be a problem. So I don't want to have, that's why we just cut half our positions. I don't want to be sitting on a boatload of problems. And if the market goes up, we're already going to make a boatload of money. So I'm not worried about that either. We're going to go to, you know, we're currently a bit under $4 million now in the long-term and short-term portfolio. If the market were to shoot up now, because we already cashed in our a lot of our TZA shorts, I'm sorry, our long TZAs, which are short on the market. If the market were to shoot up now, we could easily pack up to $5 million. So we're plenty long, and I'm only worried about the short side. I'm worried about dipping. You know, we were at 4 million, now we're probably at 3.7 combined because we cashed in our TZAs last week. That may have been a mistake. I don't think it was. How's the market holding up right now, in fact? Oh, okay, so far so good. And especially, as I talked about the other day when I was talking about the Russell, how the Russell is ridiculously, you know, oversold. It's gotten, the Russell's gotten very oversold. So, and Apple is still holding back the NASDAQ with a minus, what are they, minus 2%? That's not so bad. They were minus 4% for a while. So where are we? Okay, good. All right. Anyway, so that's how we value stuff, and that's how we look at stocks and how we figure out whether or not they're going to make the cut and get on our watch list. Petroleum. Now, there's nothing going to be very exciting here, but let's take a look anyway. We have the petroleum status report. We had a slight draw today. Oops, nope, energy. Ew, what's that? Oh, that's monthly. I say it doesn't look good. Look at that. That's good. Okay, that's what we want to see. See, good, Russell. Good boy. Good boy. Energy. Wow. That's completely undeserved. Oil this morning was at 77 and is now at 82. That's a ridiculous move. Look at gasoline. Now that's gasoline because it rolled over though. But in other words, so the contract rolled over. That's the new month contract, which was lower than the old month contract, but now it's shooting right back up to be the same anyway. Natural gas, of course, obviously always, Honey Badger always recovers. We're never worried about them. Let's see. Oil. What was I going to say? Oh yeah, the report. So we are September 23rd is the correct report. So inventories, blah, blah, blah. Very small decrease in oil. So why is it up $5 in one day? Maybe there's some legitimate war news, but I don't think so. And gasoline came down 2.4 and distillates came down 2.9. So it shows some usage, and they were all excited because there seems to be some usage in the refined products. Reality-wise, though, what actually happened? We're exporting 4.45 million barrels per day, exporting. All right, so that's 4.45 times 7 days a week, 31.15 million barrels per week is being exported. So we're exporting, and by the way, let's do the exact, I'll give you the exact number. 4.457 minus 4.346 last week, and that's times 7. So yeah, 700. So 750,000 barrels of extra oil has been exported this week. So 1/4 of these draw numbers are coming from what we're exporting. The Strategic Petroleum Reserve still is sending out 5 million barrels a week. Okay, so 5 million barrels coming from the Strategic Petroleum Reserve, and we're shipping them out of the country on a daily basis. We're shipping out 5 million barrels. On a weekly basis, they're dropping 5 million barrels, but we're shipping them right out of the country, which is a very mean trick to play on Joe Biden, who obviously doesn't understand this stuff. But he's drained out the Strategic Petroleum Reserve from 600 million barrels to basically 200 million barrels in the last year. And they're shipping them overseas. They're shipping 31 million barrels a week out of the country, out of our Strategic Petroleum Reserve. That's bullshit. That is complete bullshit. And they talk about refilling the Strategic Petroleum Reserve. You want to refill it? Stop shipping this freaking oil out of the country. Really annoying. Production is the same. Refining capacity is the same. Refining is the same. In fact, look, we're actually producing, we were producing 20.3 million. Now we're producing 19.7. That's 600,000 less barrels a day. That's 3 million barrels a week. We're producing 3 million less barrels a week, and we're shipping 31 million barrels a day out of the country. This is not in any way, shape, or form a demand story in the United States. Anyone who tells you that is just lying. It's not even that they don't understand it, they are lying. You cannot be a reporter in the energy market and not be able to grasp this very simple fact. We are exporting much, much more, double. That's almost double this number. Last year, 2.3 million barrels were shipped out a day. Now it's 4.45 million barrels per day, yet we're making 3 million barrels a week less oil. There is no legitimate demand story in the US. We are using far less. We, the people of America, are using far, far less oil than we did last year. Otherwise, we would have a draw of 10 million barrels a week. And that's not the case. We have so much oil that they have to refine it and ship it and put it on a boat and get it out of here, or it plugs up everything. And you know what's funny? You'll see this if the ports shut down. If we do have a hurricane and the ports shut down, the funny thing is we don't import enough for it to hurt the numbers, right? We import, in fact, it says right there, we import 2.7 million barrels of oil. We ship out 4.5 million barrels of oil. We used to import 3.4 million barrels. We are that's another one. We're importing less and exporting more. We're idiots. We really are. But that's because everyone's lying to you. That's because when these analysts and all these people that all take their money from the oil companies, and it's the same bullshit as Joe Manchin, is a senator who's obviously on the take to the oil companies and only does their bidding. And he's not the only one. He's just the obvious one, because it's so blatant with that guy. He can't hide. He's the Democrat who does everything he does is for the oil companies. So going completely against his own party on every single issue that involves oil companies, that's Joe Manchin. But you know what? The Republicans are an entire party of people who do everything they possibly can for the oil companies. They've been bought and sold long ago, long time ago. Those guys have been owned by the oil companies. Joe Manchin is one of the obvious Democrat by the oil companies. There's probably other Democrats who aren't so obvious about it. But the Republicans, pretty much to a man, are owned by oil companies. It's such a scam. And we are suffering. We're the ones paying for it. We're the ones suffering for it. And that's not just money. It's our foreign policy. It's everything we do revolves around this bullshit that we're being robbed. So that's bad. I'll leave it with that. That's bad. So meanwhile, last year, gasoline was $3.17 last year, and we lived. Now it's $3.71, which is bullshit, and Biden's bullshitting about it too. He's like, how is this possible that oil was 74 and now it's 79? So oil is 5% higher, but gasoline is 20-something% higher. How is that right? You know why? Because we're shipping it all out of the country. That's why. The supply is being shipped away from where the demand is. So now we are left with less supply. We don't need it. We don't want as much oil. We wanted far less oil, but they've taken more than that and shipped it out of the country. So now there's less oil left for us, even though we don't need as much as we used to. And that maintains the high prices. It's a gigantic, huge screw job scam going on in this sector. So keep that in mind when you fill up this weekend. All right, guys, so let's see. VFC is one of my favorites, was it? Okay, I'll take a look. We'll do that in chat though. Please remind me. Okay, I'll take a look at them later. 6% dividend. Yeah, you're right. That's actually not a bad idea. I like it. So VFC. I'm actually writing that down on my little thingy. VFC, but do remind me so I put it into chat, and we'll talk about that one as well. All right, so that's what we're going to do. We're going to go back to chat. We're going to finish up these things this week and make sure that we have all our bottom fishing done. And then it's going to be time for, well, then we're going to be into October. And we've got 2 weeks before October earnings start really kicking in. Then the same time, we'll be starting to do our portfolio reviews for the next month. And hopefully, like I said today, we have some kind of a technical recovery in the S&P before things get kind of ugly. All right. So that's where we are. Thanks for coming, everybody, and we'll do it again next week. All right, take care.